Hello everyone, welcome to the second of our ACCA P7 Advanced Audit and Assurance lecture recaps. This lecture was on ethics. So the first thing we looked at with regards to ethics was our ethical principles that the ACCA set down for us. First of these is that we must act with integrity, i.e. we must act in a straightforward and honest manner. We must have objectivity, we must show no bias, we mustn't have any conflicts of interest, and there mustn't be undue influence. Professional competence and due care, well, we must act with diligence in all of our dealings, and we must also update our knowledge with our CPD requirements. Confidentiality, we must keep client information confidential unless we have a professional duty to do so, for example with money laundering rules, or if it's in the public interest. And lastly, professional behaviour, we mustn't act in a way to bring the ACCA into disrepute. So those are our 5 ethical principles. Ethical threats then. First ethical threat is self-review. For example, reviewing your own work. If you're an auditor who also provides the tax work for someone and you're reviewing your own tax comp, that could be perceived to be self-review. Familiarity, well, that's simply where you become too familiar with your client. Advocacy, this is where you become an advocate for your client, who basically speak on their behalf, and again it stops you being objective. Intimidation, when you're afraid of the client, maybe revealing information about you, or maybe physical intimidation as well. And self-interest. So these are all the ethical threats that can make you act against the principles that the ACCA have set down for you. So how do we safeguard against some of these things? Well, the profession issues some things that will safeguard against it. For example, you have to have the entry exams to be part of the ACCA. You have to continually update your knowledge through CPD. You have to uphold the corporate governance requirements. And there are the standards there in order to help you. In work then also, your employer should have things like a code of conduct, and there should be ethics within the firm, and there should also be internal controls within the firm. As an individual then, you must go to your CPD and you must keep up to date, and these will keep your knowledge fresh and ensure you can act with diligence and professional competence. So how do you resolve issues? If you do think there's an ethical threat, how do you resolve this? Well, first of all, you've got to assess the facts, make sure you understand what the facts are. You then got to consider the ethical issues surrounding those facts. Do any of those issues then come into conflict with the fundamental principles that we've just looked at? If they do, there should be established procedures within the firm to deal with it. If there isn't, you may have to look at alternatives, such as going to an external regulator, or in fact resigning your position. So that is ethics. How do we manage the threats then to our ethical standards? Well, let's look at each of these in turn. First of all, on confidentiality. Remember that we must retain confidentiality unless we have permission to reveal the information, it's in the public interest to reveal the information, or if you have a legal duty to reveal it. And that may come under drug trafficking legislation or perhaps money laundering legislation. So let's look in a little bit more detail at what might be in the public interest. Well, there's no hard and fast rules on this. What you've got to do is you've got to consider several things. You'll consider the materiality of the item. You'll also consider the involvement of the public, the seriousness of the infringement or the item, the likelihood that it's going to be repeated, i.e. that it'll happen again. Has it been disclosed? And is there legislation in place to guide you as to whether it's in the public interest to reveal it or not? So these are the things that you will consider to decide whether something is in the public interest. Moving on then to a conflict of interest. Well, we've got to remember that our clients' interests may actually conflict, i.e. they may be in the same line of business, they may be competitors, so their interests may not be aligned. So we've got to avoid contact between those two clients. and if we can't do that, we may have to discontinue acting for one of them. There are some safeguards we can put in place to try and stop this. We may have different partners auditing different clients. We will review all of the audits to make sure that we are maintaining our lack of conflict of interests. And we may have what's called Chinese walls, i.e. different departments undertake the audit for different clients, and those two departments don't mix or meet. So the next threat then is our threats to independence. There's quite a few of these. First of all, relationships, and we're talking here first of all about family relationships or a close relationship. Now the threat will be less where you're maybe in a distant office, i.e. the person who's related to the client works in a distant office or holds an office far below that of the reporting officer. They also may be a junior member of staff, which would reduce the threat. And also they may not actually work on that audit, so that would also reduce the threat. Safeguards to stop this threat, well, we can structure the work so that the person who has a relationship with the client doesn't work on that area, or we can remove them from the engagement. Simplest thing to do. Staffing then. If you are moving from your audit firm to be employed by a client, you must leave at least 2 years between working for the auditor and working for the client. You must rotate the audit partner every 5 years, and they can't be reappointed within 5 years. And this brings us on to financial interest. Financial interest, for example, would be if you have shares in the business. You must dispose of the shares or be removed from the team. Pretty straightforward on that one. A business relationship would be such a thing as a joint venture, and it's very simple as well. It's not acceptable. You can't have a business relationship with a client. What about a time when a firm may rely on a client? Well, if they're a listed company, that company can't make up more than 10% of your total fees. An unlisted company, well, they can't make up more than 15% of your total fees. So look out for these in a question and apply those criteria. Non-audit work, well, if the firm is listed, just remember that you cannot prepare accounts for that firm. And that is our lecture on ethics and how to manage the ethical threats.